Let's begin by examining the current state of the API sector, particularly focusing on the recent trends in upstream raw material costs and their implications for the industry. So, what's the first thing we notice when we look at the big picture? The cost of making things cheaper is getting more stable. Look at Figure 1, crude oil prices, after that rollercoaster ride hitting rock bottom during the pandemic and then soaring to over $140 a barrel, have found a bit of a resting place around $60 recently. It's not exactly calm seas, but compared to the wild swings, it feels like a lull. And it's not just oil. Figure 2 shows the CRB spot index, which tracks a basket of industrial raw materials, telling a similar story. After peaking around 700 points in 2020, it pulled back and has been hovering around 550 points, showing signs of settling down. Why does this matter? Well, for API manufacturers, these are often the foundational ingredients. When these upstream costs stabilize, it takes a significant chunk of pressure off the cost structure. It's like the tide receding from the shore. Suddenly, the landscape looks different, and companies can start thinking about building something new rather than just bracing against the waves. This stabilization provides a bit of breathing room, a foundation upon which other strategies can be built. Now, let's talk about the currency game. Figure 3 shows the CFET spot rate for USD to CNY. See that upward trend? Especially after 2020, that means the RMB has been depreciating relative to the US dollar. Now, why should an API company care about this? Simple. If you're selling your products internationally, a weaker RMB makes your goods cheaper for foreign buyers. It's like putting a price tag on your product in a foreign currency, and suddenly, that tag looks more attractive because the local currency buys more of your currency. This depreciation acts as a tailwind for exports, potentially boosting sales volumes even if domestic prices remain flat or even fall slightly. And look at Figure 4, the producer price index for Chinese chemical APIs. It took a dip, reflecting some of those internal pressures we'll discuss, but it's showing signs of bottoming out and starting to creep upwards again. This combination, stable input costs combined with a weaker currency making exports more competitive, creates a potentially favorable environment for export-oriented API producers. It's a double-edged sword, though, as it also puts pressure on domestic pricing power. Okay, let's zoom in on specific drug classes. First up, the sartans, valsartan, telmisartan, key players in hypertension treatment. Figures 5 and 6 tell a pretty stark story. Look at valsartan in Figure 5. It peaked dramatically around 2,000 yuan per kilogram in late 2019, then came crashing down. Telmisartan in Figure 6 followed a similar pattern, peaking around 820 yuan per kilogram in late 2019, before settling into a much lower range. What's driving this? The text points to a cocktail of factors: the lingering effects of the pandemic, the general economic climate, and crucially, intense competition within the industry itself. When demand is uncertain or when everyone is trying to grab market share, prices tend to get squeezed. The result? These APIs, once potentially high-value commodities, are now trading at the bottom of their recent price ranges. For companies heavily reliant on these products, this translates directly into profit pressure. It's a tough spot to be in, highlighting how quickly market dynamics can shift and impact profitability in specific segments. Moving on to antibiotics, specifically the penicillin family. Here, the picture gets a bit more nuanced, almost like a mixed bag of flavors. The overall trend, as mentioned, is downward pressure due to fluctuating demand. Figures 7 and 8 show the key building blocks, penicillin, industrial salt, and the crucial 6-APA intermediate, experiencing significant price drops. These aren't just minor fluctuations, they represent substantial declines from previous peaks. And naturally, this ripples downstream. Figures 9 and 10 show amoxicillin and ampicillin APIs following suit, their prices also falling. However, it's not all doom and gloom. Look at Figure 11, 7-ADCA, a critical intermediate for cephalosporin antibiotics, shows a much more resilient profile. Its prices haven't seen the same dramatic drop. This suggests different dynamics at play, perhaps related to supply constraints or differing demand patterns for cephalosporins versus penicillins. But even here, there's a counterpoint. Figure 12 shows ceftriaxone sodium API, another important cephalosporin, also experiencing a price decline. So, while some parts of the penicillin world are struggling, others show resilience, and even some cephalosporins aren't immune. It underscores the complexity of the antibiotic market, where specific product lines and their supply chains react differently to the same macroeconomic signals. Now, let's switch gears to another class of antibiotics, the macrolides, including erythromycin, azithromycin, clarithromycin, and roxithromycin. If the penicillin story was a mixed bag, the macrolide story is one of strength and stability. Look at Figure 13, erythromycin thiocyanate. It's been on a steady climb, reaching and maintaining relatively high prices. The report attributes this to supply-side restrictions, meaning it's harder to produce enough to meet demand. Then, look at figures 14 and 15. Azithromycin and clarithromycin both show strong, sustained price increases, driven by a combination of rising upstream costs and robust demand for these widely used antibiotics. Even roxithromycin, shown in figure 16, follows a similar upward trajectory. This contrast with the SAR and penicillin classes is striking. It tells us that market conditions aren't uniform. Supply constraints, coupled with persistent demand, can create pockets of high profitability and price stability, even amidst broader industry headwinds. For companies producing these specific APIs, this is clearly a positive sign, offering a buffer against the pressures faced elsewhere. Alright, let's turn our attention to the veterinary API segment, the stuff used to keep farm animals healthy. Here, the narrative is one of struggle, primarily due to oversupply and weak demand. Think of it like this. Too many farmers decided to grow the same type of crop, but not enough consumers wanted to buy it. The result? Prix plumé. The text gives us concrete examples. Florfenicol, its average price collapsed from a range of 400 to 700 yuan per kilogram, down to a mere 150 to 200 yuan per kilogram, as shown in figure 17. Doxycycline, another common veterinary antibiotic, also saw its price fall to historical lows, as indicated in figure 18. This isn't just a temporary dip, it's described as a continuous decline. The consequence is brutal for some players, continuous losses. This harsh reality acts as a powerful force for industry consolidation. The weaker players simply can't sustain operations and are forced out of the market. It's a classic case of market correction, where excess capacity gets trimmed away, often painfully, until the market reaches a more balanced state. But wait, could there be a glimmer of hope in the veterinary space? The report suggests a potential turning point, looking at weekly data trends. Figure 19 shows florfenicol hitting what appears to be a historical low point in late 2025. Is this the absolute bottom? Hard to say definitively from a single data point, but it's a critical juncture. More interestingly, look at figure 20, doxycycline. After falling to those lows, the price seems to have stabilized and even shown a slight rebound. This isn't necessarily a full recovery, but it could signal the end of the sharp decline phase. The interpretation offered is that the painful process of industry consolidation might be nearing its end. With the weakest players likely gone, the remaining capacity might now align better with demand. This could mean the worst of the price declines is over, and the market might be poised for a gradual recovery. It's still early days, but these weekly charts hint at a potential inflection point, a shift from correction to stabilization or even growth for the surviving veterinary API companies. Let's briefly touch on two specialized APIs, heparin and iodine. Heparin, shown in figure 21, had a dramatic run from 2019 to 2021, peaking above $15,000 per kilogram. That boom led to overcapacity, and prices subsequently fell sharply, particularly in late 2023, partly due to non-standard market activities. By 2025, the price has stabilized around $4,000 per kilogram. It's a classic boom and bust cycle, followed by a period of adjustment. Iodine, shown in figure 22, tells a different story. From 2021 to 2022, supply disruptions, earthquakes in Chile and Japan, pandemic impacts pushed prices up significantly, peaking above $60 per kilogram. While prices eased somewhat, by 2025, they've shown a slight rebound. The report suggests this is partly driven by strong demand from other industries, not just pharmaceuticals. This highlights how even niche APIs can be subject to significant price volatility driven by both supply chain issues and broader market demand shifts beyond just the pharma sector. Okay, let's pull back and look at the financial performance of the API sector as a whole, based on a selected group of listed companies. Figures 23 and 24 paint a somewhat concerning picture for the second quarter of 2025. Both revenue and net profit are showing declines compared to earlier periods. Now, why is this happening? The report points to a couple of key reasons. First, falling prices for certain intermediate APIs, as we saw in the penicillin and SAR examples, directly impact the revenue generated from those products. Lower prices mean less income, even if sales volumes stay the same. Second, and perhaps more strategically, many API companies are actively investing heavily in innovative drug development. This is a good thing in the long run, but it's expensive. R&D spending eats into profits in the short term. So, the reported decline in net profit isn't necessarily a sign of failing core business, but rather a reflection of strategic investments aimed at future growth and the impact of volatile commodity pricing on the traditional API business model. It's a balancing act between the present pressures and future aspirations. Now, let's dissect those financials a bit further using figure 25, which compares gross margin and net margin. The gross margin, represented by the red line, is remarkably stable. It hovers consistently around the 38 to 39% mark. This is a crucial insight. It suggests that despite the price fluctuations for specific APIs, the fundamental profitability of the core API manufacturing process itself hasn't changed much. Companies are still making roughly the same percentage of profit on their sales before accounting for overheads and other expenses. However, look at the net margin, the blue line. It's a much wilder ride. There are sharp dips and spikes. The report mentions non-recurring factors like asset impairment contributing to this volatility. This is important. It tells us that while the engine of the business, the gross margin, is running smoothly, the overall financial picture, reported by accountants, the net profit, can be jolted by one-off events or strategic decisions like those R&D investments we just discussed. So, stable core profitability, but the final number on the bottom line can swing quite a bit. How does the market view this sector? Let's look at valuation, specifically the price-to-earnings ratio, shown in figure 26. The trend here is quite telling. After peaking at over 100 times earnings way back in 2015, the PE ratio for the API sector has been on a long, slow decline. It hit a trough around 18 times earnings in February 2024. That's a significant drop, reflecting investor concerns about the sector's prospects during that period. However, the chart also shows a recent stabilization and even a slight rebound. The report suggests this improvement in valuation is partly linked to the strategic shift we'll discuss next, the move towards innovative drugs. Investors seem to be starting to recognize and value this transformation. It's like the market saying, okay, maybe the old API business model is facing headwinds, but the companies adapting by moving into innovation are worth looking at again. This valuation recovery is a positive signal, suggesting that the narrative around the sector might be changing in investors' minds. And here we arrive at the central theme of the report, the strategic shift towards innovation. This isn't just a minor tweak, it's a fundamental reorientation for many established API companies. Table 1 provides a snapshot of this movement. Look at Huahai Pharmaceutical, a major player, now focusing heavily on oncology and autoimmunity, with several drugs in advanced clinical stages, like HB0017 in Phase 3. Borie and Pharma also has a program in Phase 3. And Li Kang and Federal Pharmaceutical are pushing forward with multiple projects across various stages, including preclinical and early clinical trials, some even seeking approval in the US. This isn't just about making generic APIs anymore. It's about developing novel therapeutics. Why is this happening? Because the traditional API business, while profitable, faces intense competition and price pressures. Innovation offers a path to higher value, greater differentiation, and potentially better long-term growth. It's a bet on the future, requiring significant investment today, but aiming to transform the company's identity and fortunes tomorrow. So, wrapping up, the API sector is navigating a complex landscape. We see stabilizing input costs providing some relief, but also significant pricing pressures in certain segments like sartans and penicillins, alongside pockets of strength in others like macrolides. Financial performance reflects these challenges, with revenue and profit facing headwinds, although core margins remain stable. The most compelling story, however, is the strategic pivot towards innovation. This isn't just a trend, it's becoming the imperative for survival and growth in a maturing market. The road ahead involves managing short-term pressures while investing heavily in long-term transformation.